Hey everybody, welcome once again. Kevin and Rick here at Paperstac, and we're reviewing the 2019 mid-year report. You should already know where to find it now, but just in case you don't know, go to paperstac.com, scroll all the way down to the bottom on the right-hand side, click on that report under latest news, and you'll see this 2019 mid-year market report. A lot of interesting numbers about Paperstac, about the industry at large, and especially about the opportunities and returns that you all can receive in the note industry, and specifically using the Paperstac as your trading platform. On the bottom here now, we're going to talk about in this particular video the deal and asset overview. What's selling? How are deals getting done on the Paperstac platform here? And we're going to combine several different things here. We'll start with performing versus non-performing, where you had 62.5% performing assets were sold. Of all the assets sold, 62.5% were performing, 37.5% were non-performing. What are your thoughts on that?
Microeconomics takes me back to college. Supply and demand. Right now, the market's strong. Less people are defaulting. There's less supply of non-performing loans. We're going to have more performing stuff trading on the platform. Pretty healthy for our market, and a lot of people love to buy the cash flow. It really is probably, I could see that jumping even a little bit more as the people flee the stock market. We've had quite a rocky past couple of weeks. Things have been up and down, very volatile. Some stability is being searched out. So I can see the performing number even boosting up a little bit. Do I think it'll always be like that? No, I don't. I think if the real estate market takes a dip, I think you're going to see it level out to even non-performing sort of take the lead there. So it'd be interesting to see how that goes.
Yeah, I agree with you. And of course, what's happening in the big picture in the marketplace is there's a lot more notes that are getting worked out by the bigger entities and then resold for various reasons and such that we don't need to get into. But you're right. If the market does take a downturn and all of a sudden the number of loans that go into default starts to increase, you'll see banks quickly get away from working these notes out to just selling them. In fact, you remember, gosh, 9 years ago, 7 years ago, it was non-performing was it. Everybody wanted to be in that. And it was probably more 80-20 at least at that point. So the market's changed a little bit here. But yeah, that's going to be a sliding scale, I think, that's going to change over time. Do you remember what it was last year at all, or when you looked at these numbers?
No, I don't remember what it was, but I think you're right. It is a sliding scale. It sort of mirrors inversely the pulse of the market. You know, when the market really starts to go downhill, you're going to see the non-performing stuff come up. And I do remember, man, shoot, everybody was non-performing. I didn't think I ever saw a reperforming pool take. Yeah. It was like, you know, it took me a couple years to figure out what's a reperforming loan. Right. You know, non-performing was just, you know, we're getting bombarded with that stuff right now, and it's still out there for sure. But it's, yeah, I think this is definitely reflective of the strength of the market right now.
Yeah, and this thing can change really, well, it probably changes on a weekly basis, a monthly basis of where people are on this. And I think a lot of people are looking to modify their portfolios, you know, have some non-performing, have some performing notes in there, and that can be a smart play to make as well if you've got a pool of those assets. So right now, swinging towards performing, and non-performing, those still very strong at 37.5%. Again, if you look at those numbers, and as we'll continue to do for you, it makes it very attractive when you know that you can buy at the ratios that we're talking about at the other videos. 38%, I believe, was the 36% on non-performing first position loans on average. It may make some people in the performing side start to think, well, maybe it's time to look back at those. So pretty interesting there. They were in mostly single assets versus pools. That makes a lot of sense to me.
Yeah. We have had some small micro pools go through there, but a majority of the stuff has been just the one-off assets. We've really seen, especially within, it's probably not indicative on this report, but in the past month, we've had a few institutional sellers come onto the platform and liquidating stuff on the one-off basis. So that's going to be interesting to see how, if this number holds true. Paperstac really has been we're able to scale infinitely. We're working on developing that pooled transaction up to that 50 to 100 transactions at once. You may see this number start to change, but for the most part, there's a lot of single assets on there. People are really, which is good. It's good for the one-off investor to be able to get in there and know that they don't have to take down an entire pool of assets. They can come in, they can buy one asset or two assets individually, and really piecemeal and be selective on what they're buying.
Right. And if you do have enough capital for a pool, there is a search engine on Paperstac. It'll be on the left-hand side when you're setting up what assets to take a look at. And you can click on pools or individual assets if you want to take a look at what those are, how many notes that includes. And of course, you're buying more, so you're going to get a little better price on those pools. But of course, the cost of entry is going to be a little bit higher. But single assets, again, has always been very popular in the note business, and you find those deals that fit your specific goals and needs. And that's the first process in this business, is think about what do you want to accomplish, what are your yardsticks of measurement, and find those single assets that fit you. And this is a great place to do it, where you can look at all of those. But pools, you can diversify a little bit. So again, if you're looking to diversify a portfolio, having a mix of performing, non-performing, single assets versus pools is probably the right direction for most of you to go, as perhaps maybe first and second position could be as well. We're looking at 65% first position and 35% second position. Again, not surprising for me in that one.
No, not at all. It's the first position loans they're selling. There's more of them on there, so they tend to sell. And this is pretty much indicative of the split. We've got about a 65-35 split of what's listed on there, so you would expect the same on the sales side. So this is pretty right on. This isn't shocking for me at all, just to see that the first position is kind of the big winner on volume.
Mm-hmm. I would say ideally for somebody who's looking to build a portfolio, again, whether that's in your retirement accounts or outside of that, having a mix of assets always makes sense because they deliver a different exit strategy for you. Single assets, pools always make sense. First position, possibly second position for those who want to test the market on that. Those numbers were pretty impressive, and it may be time to take a look at those. But we do have a third a way to look at things as well. And we're not going to talk about so much in this, but you can't ignore the fact that Paperstac has a new fund, a sister company, if you will, called Money with Meaning. And we're going to spend a lot of time in other places about this, but you have to simply look at that and go, what's a way for a small investor to do everything I just said, diversify a portfolio? And the answer today is Money with Meaning Fund, right?
Yeah, absolutely. If you're looking to invest your money, the entry price into the fund is $200. You can invest as little as $200, which is crazy. And that's going to get diversified with everybody else's money. So whether you're coming in with $200, you're coming in with $1 million, we're paying you up to 10%. That's up to a 10% return on your investment, and you're just going to leverage our expertise, what we've been doing for the past 8 years of buying assets and working them out. And you have the benefit of having it in a structured fund. So it's a Regulation A+ fund, which is the SEC's way to say that it's not just for accredited investors, it's for non-accredited investors too. So anybody can participate, which is something that we were very adamant about, is we wanted to give sort of that lower price band families that we've been saving their houses in the lower price band. They should have that same opportunity to invest. So that's why, mwmfund.com. Go over there, check it out. If you're interested, you can get started with as little as $200.
Yeah. And if your ears didn't perk up on that, I know we covered it briefly, but if your ears didn't perk up on that, go back and listen to the tape again and what we just said there, because we covered it very lightly, but it's a game changer in the industry. Imagine having the diversification of a big portfolio that really is normally the ground of somebody who has a lot of capital to deploy. Now you can get into a fund that might own 100, 200 assets in there, and you own a small part of that by investing as little as $200. And by the way, you can even set up a monthly investment. And again, we could go on this all day, but we're going to do that on a different video for you here. But mwmfund.com, check that out. Look at individual assets, buy individual assets, first or second position based upon your risk, performing or non-performing based upon your exit strategies. But also it could make sense do both. Invest in individual assets, invest in a well-managed fund that's been through the SEC process. So more to talk about on the next video for things that you may not know about that can hugely benefit you, ease risk for closings and such. If you have a little anxiety about sending money and all that, we're going to talk about all about that on the next video, where we talk about the escrow versus direct to seller payment, the collateral auditor, and of course self-directed accounts. So we'll see you on the next video.